What is up, YouTube? All of a sudden, everybody's a banking expert. Got a little run on the bank. Where are they getting their data from, though? That's what I would ask you. What expertise do they have on the subject? I'm going to show you the expertise I have. See this book? That book is about the largest bank crash, takeover, whatever you want to call it in the U.S., called Washington Mutual. That bank crashed in, I think, 2008, 2007, 2008. Don't remember which year, during the last financial crisis. In this book, it explains exactly how this bank crashed. And it was a run on deposits, but it was way, way worse and over a way longer timeline than the current bank, SBV, the Silicon Valley Bank. The Silicon Valley Bank happened almost overnight. Washington Mutual was over a series of weeks. Back then, Congress was debating on whether or not to pass TARP funds. The FDIC was nervous about the run that was happening at Washington Mutual. Washington Mutual, much like SBV, secured a loan right before the FDIC took it over. What does the FDIC takeover mean? It means that the FDIC, what does FDIC stand for? Who knows? Put it at the bottom of the screen. Anyways, the FDIC held a silent auction for Washington Mutual, and it sold for $1 billion. This bank sold for $1 billion, even though it had $53 billion in deposits and over $150 million in assets. To understand what's going on in a bank, you have to understand a bank's balance sheet. What is on a bank's balance sheet? There's assets and liabilities, much like your own balance sheet. But on the bank's balance sheet, cash, the actual cash in a bank, is the liability. The assets are the loans, real estate. If they own any bonds, like this particular bank, SBV, owned a bunch of bonds, those are the assets. The cash it has is a liability. You might ask, why is the cash a liability? Well, it's because if people come in and say they want their cash, then they have to give them their cash. And they don't have enough cash in the bank to actually give everybody the cash that is on their books. Does that make sense? So in any situation like this where there's a run on banks, the bank will have to liquidate assets. What are the assets? Again, bonds, loans, things of that nature. What assets can they sell in a short period of time? It's always the same. It's the same on your own balance sheet. What's the most liquid item you have at your house right now? It's going to be your best assets. It's going to be your guns. It's going to be your most precious metals. It's going to be your car that you owe the least amount of money on. Those are your most liquid assets. For the bank, their most liquid assets at that time were bonds and a package of loans, I believe. I think they had a package of mortgage-backed securities. But after you sell the best assets, what are you left with? A bad balance sheet. So what they had to do was they had to plug the hole. So they sell their best assets. They bought those assets with bank deposits. They sold those assets and had to take a haircut on them. So let's say they bought them for $1 billion and now they're selling them for $500 million. So they took a loss on it. So now they got to make up for the loss. Their plan to do that was to issue stock. Now, stock in a bank, I never will understand this. In every single bank crash, in the Washington Mutual crash, the only people that lost money in the Washington Mutual crash were the stockholders. Why people own stock in a bank? Never know. I don't know what the upside is. I don't know what you're banking on. I don't know if it pays a dividend every month. I have no idea why anybody would ever own stock in a bank. But to plug the hole, SBV went to do a stock issuance. They never got that far in the process. The run on the bank was too strong. Now, in this particular bank, they had a bunch of heavy hitters, the way I understand it. They had a bunch of people with a large deposit amount walking in and taking out millions and millions of dollars. Normally, a run on the bank happens from small people. People with $10,000, $15,000, $20,000, they get nervous. They want to go to the bank and get that cash and take it home with them. Enough of those people do it in a big bank like Washington Mutual, where they had branches all over the nation. Now, they were losing something like $5 billion a day in cash withdrawals right before the FDIC took them over. SBV, on the other hand, only had a handful of depositors go in and request cash, and they were so big that it just tanked them. The FDIC looks at this. They hold the insurance. They hold the bag on this particular deal, and they do not want to pay out those $250,000 insurance policies. They don't want to pay it out. So when they take over that bank, they then start the process of selling the bank as a whole, okay? So now everybody's talking about the government takeover or the government bailout or the government this or the government that. You got Republicans yelling, oh, this is a bailout. You got Democrats yelling, oh, this had to happen. Nothing can be further from the truth. This is not a government bailout. The Fed, the central bank, stepped in. We're going to guarantee deposits. That's all they said. We're going to guarantee deposits. What did they do in that one simple task? They made this particular bank stable enough and attractive enough that somebody, another bank, a larger bank, can step in with $1, with a single dollar, and buy the entire bank. Do you understand what that means? I don't know what SBV has left as far as deposits on their books. They could have billions of dollars still in there. Another bank can now buy them for $1, take over their liabilities, their cash, and get all of their assets, their loans, which I think are credit lines. I'm not really sure what kind of loans they made. I think they had a bunch of credit lines to venture capitalists. But at that moment in time, they now own that bank. So all the Fed did was make that deal attractive to somebody by taking all the risk out of it. They took all the risk out of purchasing this bank by guaranteeing the deposits, which is basically a loan. They didn't inject more capital into the system. All of these things are a little bit gray and a little bit false. All they did was make it attractive for a suitor like, say, Wells Fargo or Bank of America or some bigger bank to step in and buy that balance sheet. Now, this is business 101. When a larger bank steps in to buy this smaller bank, all of the notes, all of the loans that bank made are going to have some language in those loans that say, in the event of a takeover, you're in technical default. What does that mean? The new bank, the new owner of the bank, can go read over those loans and say, okay, Steve has $3 billion in the bank. He owes us $2 billion. Let's call his note due. Let's make him pay off this note right now with some of the billions that he has in the bank. If he doesn't want to do that, then he has to go establish a new loan at a new bank. When that happens, they'll run through that balance sheet. They'll make themselves whole again by calling notes due, okay? And they'll even out the balance sheet. They'll make it where it's a good deal for them. It's a good deal for the shareholders of their current bank. It's a good deal for everybody involved. Here's the ironic part about all of this. There was a huge run on bonds on Monday. So yesterday, there was a huge run on bonds. So people took their cash and they put it into bonds. There was also a huge run on crypto. They took their cash and they put it in crypto. But here's where this logic is flawed. All of that money is still sitting in a bank somewhere. Some bank is still holding on to that capital. All capital is sitting in a bank. When you're buying a house, one bank wires money to the title company. That money is sitting in the trust account of the title company. Money sits in a bank regardless. When you buy stock of AT&T, it goes into a bank account. It is always, always, always sitting in a bank account. For those that say that the government shouldn't step in, the Fed shouldn't step in, nobody should step in and insure deposits, you're absolutely crazy. I want to give you a scenario. Right now, we use an app called Appfolio. Can you see this? That app right there is called Appfolio. It says we have $380,000 in rent collected. Where is that money right now? So let me give you let me break it down for you a little further. A tenant can walk into a 7-Eleven with cash money, and pay their rent. That is part of that $380,000 balance I just showed you. From that moment, it goes into 7-Eleven's bank account, wherever that bank may be. Could be a local bank, could be a big branch bank, could be anywhere. They pay their amount, boom, it goes into their bank account. From there, it has to go to Pay Near Me, which is the software that allows them to do it. That bank account could very well be SBV. They're a technology company, okay? From Pay Near Me, it has to go into Appfolio's bank account, okay? So then it goes into Appfolio's bank account, which is, they're based out of San Francisco. So it could be one of these banks that's at risk. They haven't emailed us, so I don't think it is, but it could be. From there, the $700 rent that the tenant paid in cash at a 7-Eleven in Texas is now in a San Francisco bank. From there, it gets wired to our bank in Waco, okay? So once it's in our bank in Waco, on about the 10th or the 15th, we pay out all of the rent to the owner. How many steps was that? 7-Eleven, Pay Near Me, Appfolio, property management, then the owner. It passed through 5 banks just to make it to the rightful person. That person then has to pay the mortgage on that property, okay, which is another bank that's at risk in this whole transaction. If anywhere in there, one of those banks is having a run on bank and deposits get freeze, look at all the people down the line that get affected. If it happens on the Pay Near Me side or at the 7-Eleven site, then all of those banks down the line get disrupted. That's called contagion. The contagion on this has legs. Etsy was one of the ones that was the biggest name that I noticed that I knew was affecting people close to home. People buy and sell stuff on Etsy all the time. Could you imagine already shipped inventory to the tune of $10,000 or $15,000 and that money sitting in Etsy's bank account, and all of a sudden it can't make it to the person that created that product, that spent their time, money, blood, sweat, and tears on that product, because now it's all tied up in a bank failure? Do you realize how asinine that is, that people want the depositors to be holding the bag on this? I absolutely agree that the shareholders of that bank should get wiped out. But depositors, the one thing that you rely on in the United States from the government is a currency that has value, a currency that holds value, and a currency that you can depend on. And how can you depend on it if a bank goes under that you can have no control over, and now your money no longer exists? You had $1 million in the bank, you worked your whole life for it, it's sitting in the bank, it's safe, and then all of a sudden it's only $250,000. That's an asinine way to think about it. Is that the right word, by the way? Good. Okay. So the politicians and the people on the internet that say the depositors should take a haircut, they're absolutely wrong on that. The depositors should not take a haircut. They should do exactly what they did. Step in, stabilize that asset, make it to where another bank will buy them out so everybody can continue doing business. In our business of real estate, you wire money to a title company. Almost 100% of the time, that money is more than the FDIC insurance amount. Imagine that title company getting shut down, that title company's trust account getting shut down. All the transaction that was wired in that day are now sitting there frozen. You've got people that are relying on that money to move to their next house. You've got people wanting to move into the house they just bought. The loan exists at their bank, so they got to start making that payment. And now the title company's trust account got wiped out to no fault of their own. And they don't have insurance for that amount of money because it's a single bank account. And in that single bank account, millions and millions of dollars of transactions of trust money, of money that's not theirs, goes into that bank account every day and leaves it in the same day. And now that's shut down. These are problems that nobody in the banking system could ever underwrite, or I don't know. I don't even know what the right word is. You can't put that into your prospectus. You can't put that into your business plan. You can't underwrite that into your real estate transaction. And now you're going to cause that problem. What kind of chain reaction would that create throughout the economy? So the people that are saying that it shouldn't be a quote unquote bailout, which is not a bailout, couldn't be further from it. Taxpayers are not going to be on the hook for this. This is a simple loan. This is a simple stabilization that makes that assets of the bank, of what's left of the bank, the skeleton that's left on the bank, I don't know, makes it look like something that somebody should step in and buy. All I'm trying to say is, your little internet experts that have read this or watching this or seeing this and they're arguing over the facts, the simple fact is this: without a banking system, you ain't got a country. Without a banking system you can depend on, there's complete chaos. If contagion spreads throughout the banking system, that's wild. The other thing is, all the people that remove their money from a bank, guess where your money is now? Still sitting in a bank somewhere. Didn't think about that, did you? Unless you went in and got it out cash, which if you did, bravo, good for you, whatever. Just don't tell nobody on the internet, because I'm sure they'll show up at your door. If you want to know more about real estate, banking, all that kind of stuff, subscribe, like this, put what you think about it in the comments section. Let me know if I'm right. Let me know if I'm wrong. Let me know if you understood it. Let me know if it even made sense. I love being called dumb on the internet. We'll see y'all on the flip side.